So if you go on Island, you are going to see a blank page of this example posted. Please do not look at the solution and take 5 minutes. Try to work on it on your own first, and you can pause your video for now. So we have the firm's balance sheet here. The first step in making the cash flow statement is calculate all of the change in the non-cash balance sheet accounts. So the first step is to calculate the change. For example, account receivable, the change is 1967. Inventories, prepaid expense. And then we have investment, equipment, account payable, accrued expense, contributed capital, retained earning. So just take all of your balance sheet items. You don't need to worry about cash, but for all of the non-cash balance sheet items, calculate the change during the year of those accounts. And then the second step, explain or decompose the change if necessary. Work our way down through the information we are given. So there are two accounts here. We need to pay attention. The first is PP&E. So as you can see here, the PP&E, the change is 8. The beginning balance is 31879. So 31,879. And then the ending balance is 31887. 31,887. And why does the PP&E change by 8 during the year? It is because the information is given here. The company purchased additional equity for 1,736, sold the equipment at its carrying value for $2, and depreciation on the equipment for the year is 1,726. So the change is because of 1,736. That is the purchase of PP&E. And then sale of PP&E for $2. And depreciation 1,726. So for the purchase of PP&E, that's an investing activity. Sale of PP&E is also investing activity, and depreciation, that's operating. So the other account we need to decompose is your retained earning. Retained earning beginning balance 29,667. And ending balance 35,435. The change is because of the firm has net income for the year, 5,768. And then the firm doesn't have any dividend. So that's the net income. And the firm has no dividend. So this is the second step, to decompose some of the accounts. And then the third step is to classify each account, each of the change as operating, investing, or financing. I'm just going to do the classification here. So for all of the current asset and current liability, those are operating. So account receivable, the change in account receivable is our operating. change in inventory operating, prepaid expense operating, account payable, accrued expense, all of those are operating. For all of the long-term assets, so which is investment, that's investing, and equipment. So because of the decomposition here, it is both investing and operating. And then for contributed capital, that's financing. Retained earnings. So as you can see here, net income, that's operating. And because there's no dividend, so there's no financing activity here. So all of the retained earnings in this situation, those are all operating. If the firm paid out any dividend, then retained earning is both operating and financing. So this is the third step to classify. And then the fourth and fifth step is to adjust net income in the operating section, finish the investing and financing section. So it's basically the fifth step. We need to put everything into the format of an income statement. So let me So here, let's just go through this income statement. We first start from the firm's net income, so which is given here. And then we make those adjustments. So all of those items are actually changed in the firm's balance sheet for its current asset and current liability. So the first adjustment we need to make is this 1,726. So it's the depreciation. And then those adjustments are taken from so are those items here, which are operating related items. And then cash flow from investing activities. So those three items are basically the change in investment, and then the purchase of PP&E and sale of PP&E. And then the financing activity is coming from here, the change in contributed capital. So after we have done all of those, we sum up the cash flow from operating, investing, and financing activities. That becomes our net increase or decrease in cash. So the beginning cash balance, 63,147. It should tie to your beginning balance here. And your ending balance should tie to your ending balance here. So if those numbers don't tie, there's something wrong. You need to go back to check. So this is how to make a cash flow statement under the indirect method.